As we approach the end of Q2 earnings season over in the US, we took a step back this week to assess the macroeconomic backdrop and broader portfolio strategy. It has been a fascinating first 8 months of the year in investment markets so far in 2025. And whilst US equities did shrug off the weakness experienced in the first quarter, and many broad large cap indices have again been driven to new all-time highs, it is noteworthy that returns from US indices have been overshadowed by greater returns from most other geographic regions, with the UK market, the rest of Europe, Japan, Asia and emerging markets all delivering returns significantly exceeding that of the US in local currency terms, but also notably from a UK investor perspective in sterling terms, given the weakening of the dollar so far this year. The dollar index, which measures the US currency against a basket of major currency pairs, has fallen nearly 10% so far this year. All of this bucks the norm of the last several years, and whilst too short a time frame to draw any conclusive trend changes from, the size of these comparable moves again emphasises the need to maintain diversification in portfolios, particularly at a time when benchmark indices are looking very concentrated against the context of history. To discuss all this and more, we were delighted to be joined by Kristina Hooper, Chief Market Strategist at Man Group, to hear her current thoughts on the backdrop. Welcome to the Investor Insights podcast, hosted by Killik & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik & Co YouTube channel, or by searching for Killik & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were delighted to be joined by Kristina Hooper, the Chief Market Strategist at the global alternative investment manager, Man Group. Kristina joined Man Group earlier this year, having previously held the role of Chief Global Market Strategist at Invesco. Kristina is hugely experienced and regularly features on financial media and as a speaker at national and regional conferences, providing her view to investment professionals on the economic backdrop and portfolio strategy. Since joining Man Group, she's launched a new blog series titled Signals and Sentiment, and we'll provide a link to this blog in the description of this episode for anyone wishing to keep up to date with her current thoughts and outlook. We hope you enjoy this episode, and as always, please do get in touch using the podcast email address investorinsights@killik.com if you'd like any further information or explanation of any of the topics or terms referenced in this episode. Hi, Kristina. How are you doing today?
I'm great, Gordon. How are you?
Yeah, very well, thank you. Yeah, thank you for joining us today. So, Kristina, we've got this standard opening question which we ask all of our guests on this series, actually, and really what it aims to do is just get a bit of an insight into you and kind of how you go about your work, really. So we've been asking people for one of a range of things, really, whether it's just an anecdote that they can share from a recent meeting or something they've been working on, or even just an article or book that you've read recently. Is there anything you could share for us?
Sure, absolutely. So I should preface my comments by saying that what I try to do is find support or contradicting evidence for my main theses. And one of my key theses this year going into next is that the U.S. economy is going to go into recession, largely because the U.S. consumer deteriorates. And so I put together what I call canaries in the coal mine. What are the signs that the economy is deteriorating? Because quite often, the first indicators are not in the data so much as what we can hear from industry contacts or what we hear on on earnings calls. So I have an industry contact who is a department store buyer who I reach out to very regularly. Just spoke to her this weekend just to get a sense of how things are. Foot traffic is held up, but they are passing on more of the tariffs to consumers. So there's real concern that things will hit the fan, so to speak, in the probably within the next month. And also earnings calls. It's really helpful. I think you get a lot of insight from listening in on consumer related companies' earnings calls, and in particular, hearing their outlook, what they have to say about the health of the consumer, and what their expectations are. And so, we've certainly heard from some companies, and we'll hear from more that are sensing that consumer spending is weakening, that the consumer is under more pressure, and I think that's only going to continue. And then, of course, there are also there's also the data that can be helpful. Continuing jobless claims has gone up quite significantly. We're at a level that we haven't been at since late 2021, which is concerning. So that helps paint a picture. The anecdotal, the information from earnings calls, and sometimes the data that helps me assess on a continuous basis whether or not my thesis really is correct.
Yeah, no, thank you for that. I think that sets the scene for this discussion and what we'll come on to talk to you well. And I think a bit of department store buyers a useful friend to have to give a kind of inside track for sure. You can definitely see how that's useful. So, Kristina, we read your blog, your signals and sentiment blog, which I mean, it's been clear that as you've just kind of inferred in the answer to the first question that you're discussing a lot about the emergence of stagflation risks emerging and also the kind of predicament that central banks are finding themselves in a moment with kind of growth and inflation to kind of deal with working away at the moment. Could I maybe you kind of you touched a little bit on some of your views there, but could I ask you maybe to run through that in a bit more detail in the case of maybe talking through growth to start off with, kind of where do you see the trajectory for the kind of growth outlook coming at the moment?
So I anticipate growth will deteriorate. And as one of the members of the FOMC recently said, Chris Waller, jobs data can turn really quickly. So what seems like relatively solid right now could easily change. And I think we're already seeing signs of it with that elevated continuing jobless claims, as I mentioned. What I'm also seeing is companies that are delaying hiring decisions, that are delaying capital investment, and it shouldn't be any surprise because there is so much economic policy uncertainty, and it doesn't look like we're going to get to much more certainty anytime soon. So, that to me creates an environment in which consumers are under pressure, companies aren't spending as much as they normally would, and you also have these other additional headwinds. The end of student loan forgiveness has caused a dramatic increase in student loan defaults. And that is of concern because for those who aren't um, not paying their loans, they're under more pressure. That's probably a $300 or $400 knot on average that is being placed on consumers, weighing them down. Many households are just getting by. So, all in, this is a picture, I think, of growth that's decelerating and could very well go and the U.S. economy could very well go into recession within the next few quarters.
Yeah. What about the inflation side of things? So what was your outlook there?
So I certainly believe that we are going to see inflation go up because of tariffs. There is no doubt about it. But I agree with Chair Powell that it's most likely going to be something of a one time hit, a price shock. But I think we have to recognize that there are other sources of inflationary pressure, including very aggressive immigration policy in the US. So we have a situation where we're losing a lot of workers. The statistics on those that are self deporting because the tactics have been so aggressive, and in fact, so many who are working are being picked up and targeted for deportation. You have just a loss of the labor force in areas that are heavily dependent on immigrants, both legal and illegal. So, construction, the service industries. I think we're going to see very significant inflationary pressure there as time goes on, just given that we're likely to see a ramping up of immigration, aggressive immigration policy, given the one big beautiful bill and its allocation to those efforts. So we have to, I think, be prepared for a higher inflation going forward. And it's not just going to come from goods like it did during the pandemic, which again, we could argue is one off, but it's going to come on the services side, which I think could be far more significant and impactful for creating sustained higher inflation.
Yeah, interesting. So what happens with central bank policy against that backdrop? I mean, how have you been interpreting recent commentary from the Fed and policy, I guess, elsewhere as well? Okay, kind of how do central bankers kind of deal with that?
Well, let me start by saying that there's a huge number of people being considered for the new Fed chair. I can't imagine why anyone would want that job right now because it is so difficult because you do have those two competing interests and or competing concerns and mandates. And so it is very much a situation where the Fed has to prioritize which is the greater risk. And we've heard from Chair Powell that the risks are in balance, right? But I think that balance changes and it could change quite rapidly. And the urgency is going to be growth. I think that's not very dissimilar to the Bank of England and its recent decision. It's about growth first, and then we'll worry about inflation, especially since a good number of FOMC members seem to not be as concerned because they think of it as this one-off event. I think they're very focused on tariffs and not thinking about other potential sources of inflationary pressure. So going forward, I would anticipate at least two rate cuts this year, and then of course more next year. I think quite frankly, inflation is going to be a secondary concern probably for a while as the Fed really tries to tackle this. Now, we could see that the economy is very resilient. I could be wrong. The data could be quite good. And then that will cause a shift again and a reordering of priorities. But I think for right now, it's about growth.
Because you touched on kind of tariffs and the policy there when you're kind of answering the inflation kind of side of things. But back then, I mean, it's undoubtedly been one of the, if not the most impactful kind of element of the macro backdrop over the last 6 months at least. And I always kind of conscious I ask these questions. It's kind of ever changing, kind of week to week. But could I ask you to maybe summarize just your kind of key takeaways, what you're seeing, kind of early indicators of that policy and the impact it's having? Could I ask you just kind of summarize your thoughts there?
Yeah, sure. I mean, the best place I go to get really helpful anecdotal information, what companies are thinking, is to look at the Federal Reserve Beige Book and the ISM surveys, the PM surveys, to get a sense of companies are thinking. And it seems that it is having something of a chilling effect on business investment, on hiring. Of course, a lot of these companies are encouraged by some of the elements of the one big beautiful bill. In fact, the most recent reading of small business optimism actually increased modestly. And I think a lot of that has to do with the 20% deduction for small businesses becoming permanent. So, so there's certainly crosswinds, and there are reasons for companies to be more optimistic. But I think tariffs weigh heavily, especially given the enormity of the tariffs. Remember when Liberation Day came? I think there was just incredible shock that they were so large. So like a lobster that is, or frog that's put in a pot and then boiled over time, you get accustomed to it, right? And so I think markets are for the most part just ignoring tariffs. Businesses less so. I do think though that this is going to be a difficult stretch and it's going to go on for a while because um, it's not so clear cut as to say there are tariffs on goods. We'll make a deal and that will be over. We know that a framework can be arrived at very quickly. The details can take a lot longer. And we've already seen that, for example, the US Japan deal, it seems that the different sides have different views on some key elements. So I think this continues to be a source of real economic policy uncertainty going forward. And in the meantime, it's creating significant price inflation that's going to be very problematic. So when I think of it from a U.S. consumer standpoint, I think more and more companies will be passing on. Even those that said they were going to eat the tariffs, they're just so large that it's going to be hard for a lot of companies to pass it on. I know a regional grocery store recently said, "Hey, if it were 10% tariffs, we could eat it." But at the level, we're going to have to pass on the bulk of it to consumers. And I think that's very much the sentiment of a lot of businesses. So that was a very jumbled and long-winded way of saying tariffs are going to continue to weigh on the U.S. economy. And of course, it's going to be problematic for other economies. We've certainly seen it impact the Chinese economy despite significant fiscal stimulus.
Yeah, no, thank you for that. It certainly feels like it's going to take a long time to really be able to assess the full picture on that one. Christina, could I ask you to move on to currency markets? Because kind of sat here in the UK, I mean, the kind of weakness in the US dollar has been kind of one of those really notable features of international markets this year. And whilst I appreciate kind of the currency movements are impacted by factors that we've kind of a lot of which we've already discussed already, but I wondered if I kind of asked you for your view on kind of where currencies go from here, or are there any other considerations that we haven't discussed that you think are important for investors here?
So I think that the theme that I believe will be an overarching theme for the currency markets in coming months is that the Fed is easing, and that will help drive down, weaken the dollar relative to most other major currencies, with perhaps a few exceptions. I think probably the pound will be relatively comparable in this environment. Um, to me, the US dollar is a little different than other currencies in that there are really three drivers. It's growth expectations, it's rates expectations, but it's also that special safe haven asset class status. And I think that also is eroding. So if you have rates expectations going down, growth expectations are probably going to go down. And I think also just safe haven status. Certainly, part of the dollar's strength comes from just a desire to be, a risk off environment. But I think that there's more selectiveness going on right now. So it's not um, a natural phenomenon anymore that U.S. dollar is your go-to risk-off asset class. I think gold is emerging as something of an alternative. Other currencies are emerging as alternatives in this environment where we're just seeing greater fragmentation when it comes to trade, when it comes to currencies. When it comes to just disparities around economic growth pictures and different policies. So my expectation is USD weakens in this environment, and some of the other currencies perform better.
Maybe let's change tack slightly. So you kind of laid out kind of your economic kind of outlook there. Kind of how do we deal with that when it comes to portfolio construction and kind of where we allocate? I mean, we've talked a lot about kind of the dispersion in markets or different market segments that we've seen over quite a prolonged period now. Kind of a big wide dispersion in the valuations and returns of different segments, different geographies around the market. Kind of what are the primary considerations that you're kind of thinking about when it comes to portfolio construction at the moment?
Well, certainly valuations is a real concern. Valuations are rarely predictive in the shorter term, but they're important for those that have long time horizons. And clearly, valuations have gotten very, very high. Now, one could argue, hey, let's look at price to earnings growth. That's much more accurate, and certainly that probably makes most feel more comfortable. But at the end of the day, valuations matter. this time isn't different. And so I think ensuring that there's adequate exposure to areas where there are lower valuations. Now, um, that also means being selective, though, because one could look at their US allocation and say, oh, well, let's just increase our exposure to small caps because valuations are lower there. And that ignores the fact that in an environment where the economy is likely deteriorating, small caps could very well be hit hard. So I think this is also about assessing weights and ensuring geographical diversification, having adequate exposure to other areas of the world beyond developed markets. And I think there's a lot of opportunity right now in emerging Asia in particular. So ensuring adequate exposure there. I think economic growth looks attractive. I think there's certainly a lot of long term potential there and being selective in that space. Valuations are very high for Indian equities, not as high for ASEAN equities. So it's an opportunity to diversify there. I think adequate exposure to fixed income, but also recognizing that there's more vulnerability today with sovereign exposure. That we saw, we're seeing more and more debt being issued, and even countries that have lower debt to GDP levels, investors are to a certain extent showing signs of bond vigilantism. And so I think it's looking out and saying, where are my sweet spots in fixed income? And to a certain extent, I think investment grade is a sweet spot right now. There are just opportunities that may be overlooked where investors just don't have adequate exposure right now. And then, of course, alternatives. It's absolutely critical in an environment like this, where there's so much uncertainty, to be well diversified. And that means including alternatives in one's portfolio. They can be an excellent hedge against some of the greatest risks facing portfolios, depending upon how you construct your alternative sleeve. So to me, sort of the key focus has to be on just being well diversified and also positioned for potential risks as we head into what I think is an environment in which we're just we have the potential to see more dangers emerge, not less.
Yeah, no, thank you for that. Yeah, I agree with all of that actually. Christina, I'm conscious I've thrown a lot of topics at you already. We always get this with the kind of macro discussions, but we've got a little bit of time here at the end. I wondered if I could throw some kind of quick fire questions at you just to kind of see if there's other things that we that you could flag to us that we might need to consider over the kind of next phase of things. The first one is what you would consider the most concerning tail risk at the moment. What do you think is what kind of what most worries you within markets? I mean, you've mentioned a number of risks, but is there a kind of tail risk out there that troubles you?
So I think a very deep recession is what I fear most. I've been in the industry more than 30 years, so having lived through the global financial crisis, I think that was the most frightening thing. And we know that the U.S. tariffs of the 1930s didn't create the Great Depression, but they certainly exacerbated it. So I just worry that we could see a freezing up of international trade. We could just see ramifications beyond what others have expected. So that, or even stagflation, I do think, if it's deep enough, is a real concern because it is so hard to navigate out of, especially with the limited set of monetary policy tools.
The second one was given the kind of outlook that you've given, and markets sitting at kind of near enough all-time highs and valuations a bit heightened. This one's, I guess, might be another one that kind of reiterates something else that you said. But I wondered if there was what you would consider your kind of least consensus view, something you think that you have a view where the market just isn't pricing that at the moment, isn't even thinking about that at the moment.
I think it's a U.S. recession. Certainly, expectations went up a lot in April, and then they went right back down. If you look at high yield spreads, it was just basically a very quick U turn back down. And I don't think that today markets are accurately reflecting the recession risk at all. I don't know what's changed between then and now. We still have the same tariff picture hanging over us, greater uncertainty, just a lot of very troubling headwinds facing the economy. So I would say that is probably my greatest departure from the conventional wisdom on markets right now and the economy right now.
Yeah, absolutely. You mentioned a few areas of the equity markets, things like Asia, for example. But if there was kind of one kind of highest conviction area or asset class or strategy at the moment, where would you, I guess, be more overweight than you have been historically?
So I would say Asia EM, but in terms of sectors, interestingly, I would argue tech, but balancing developed market tech with China tech. Valuations are still low. I know there are certainly hurdles there, but what we've seen over the last 6 to 9 months is that China tech is a lot more advanced than many thought, and I think we're going to continue to be surprised on the positive side by China tech's advances.
And maybe a last one to throw you at the end. If there was kind of one macro event that you're kind of you've highlighted in your schedule that you think is going to be kind of the most impactful over the next 12 months, what are you looking at as a kind of big event coming up?
I think it would just be some sort of a global freezing of trade, just a breakdown. I think we're on the cusp of some real fragmentation beyond what we've already seen, breaking into trade blocks, breaking into regional alliances. And so for me, I worry that breakdown could lead to the reverse of the dividends we saw since really the 80s and 90s in terms of greater trade, greater cooperation, higher growth, lower inflation.
Yeah, thank you for that. Christina, I've thrown so much at you then. We've covered so much ground over such a short time frame, but I really appreciate you joining us. That was fascinating to go through your thoughts there. Thank you.
Thank you so much, Gordon. It was great to be with you.
Thank you for listening to the Investor Insights podcast, hosted by Killik & Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.